Good morning, everyone. My name is Promise Felon. I am the founder and general partner, managing partner even, of Growth Warrior Capital. Growth Warrior Capital is an early stage fund that invests in diverse and female founders at the seed and Series A stage. And our goal in the world really is to create economic sovereignty, which is the ability to bet on the things that you care about at a multi-generational level. And so our investments tend to be in the AI, machine learning, fintech, and future of work areas. And so what makes us different is actually why we're here in the trenches. So I find myself as partner in our fund and in our firm working really closely with our portfolio companies. And so our portfolio companies ask a lot of questions about finance, especially right now. And so I wanted to bring one of my favorite people, Ken Chow, to the forefront to really talk about a few things and answer some of those burning questions that not only do our early stage founders and CEOs have, but exist across the industry. And so I call him, I'm going to take credit for this, Ken. I call Ken a wartime CFO. And if you read Ben Horowitz's book several years ago, he talks about a peacetime versus wartime CEO. And I would argue for the last several runs, we've been in war or been in chaos, if you will. And so there are very few animals like Ken. Ken has had 25 years experience, and not to age him, he's been in the dot-com bust, 2008, 2013 strangeness, 2015 correction, the pandemic, right? And now in these times, and he has succeeded and won, raising nearly $1 billion in public and private financing with VC private equity. He's been in multiple IPOs and helped companies go public, from the Cobalt IPO, where it was 30 times oversubscribed, massive gains. He's helped 8 early stage companies. One was one that I ran, and he was my wartime CFO. Thank you, Ken. And completed over $2.5 billion in M&A transactions. And so Ken is what you call an interim CFO, which means that he dives into organizations when they need transformation and helps them get there. He's on multiple boards. But what I can't wait to talk about, Ken, with you are your specific experiences. And so I know we'll dive into Jumio. I know we'll talk about the Mozilla turnaround that you did, Twist Bioscience. I know we'll get into the details. And so what I want to now do is switch to the topic of our conversation. So you all are here, and I got to tell you, if you're a CFO, if you're a CEO, if you're anyone who's running a company, you're seeing things like OPEC cuts. You're seeing everything from, asset managers trying to figure out where to put money. People are, suffering liquidity challenges. These are grim and interesting times, which is important to actually look at. We can keep building from here. So this was on PitchBook today, down rounds, that's above the fold. I mean, these are really interesting times. So we can keep going, but what I want to do with all of you today is take a lot of the emotion out. We talked to our portfolio companies about valuation, how to build a finance organization, what type of debt to get, how to work with their boards. So Ken, I'm going to turn it over to you and just kind of get your sense. What do you see happening now in technology startups and in the economy? And what's your perspective on it?
Well, first, Promise, I became a CFO at about 10, so so you're not really dating me.
Yes.
But in more seriousness, these are very turbulent times, and for many folks in the audience here, seeing an inflationary cycle and interest rates moving the way they are. We've got geopolitical risk, we've got economic risk. And so, what ends up happening is our, investors and board members, they get concerned.
Yeah.
And so, because these are just tougher, it's a tougher economic environment. So, we've entered in a different kind of war, really. It's not a pandemic kind of war, so to speak, but it's an economic and uncertainty type of period that
Yes.
you could almost say like we're really already in a war. Some people think we're already in recession. Some people think we're going to have a deep recession. And, the reality is no one really knows. But what we do know is that we're in an inflationary cycle. You can't pump money into the system. And with that much money in trying to survive through the pandemic and come out the other side with no inflation.
Right.
So what does that mean for growth companies? It means that people are skittish.
Yeah.
People are starting to look at, well, what's a down round look like? In fact, I am a less experienced CFO that I some mentoring with just closed a round, which I think is awesome.
Yeah.
And one of the things that I said was like, look, what does your board think? What do you guys like? The lofty valuations of 18 months ago are yesterday. And that's not going to happen. So I said, your job and your focus is to get the company funded.
Right on.
And that may be at suboptimal terms, but the alternative is, an unsatisfactory one.
Right. I love that. And I know that people are going to have a lot of questions for you. So if questions do come up, let's integrate them into the conversation.
Absolutely. Absolutely.
So if you're in the participant stream, just jump in the Q&A and ask any questions and we'll facilitate those with Ken. So Ken, you introduced two things in that intro that I thought were really telling. One, fundraising, and two, CFOs. So most of the people watching don't have mature finance teams. They're probably, as a CEO, doing it themselves. And some have capital, some don't have enough. But I imagine all are thinking about it. So how does an early stage CEO right now think about cash preservation? How do they think about building enterprise value? What should they be waking up every morning focused on at the early stages? What's your guidance?
Yeah, it's a good question. There's no one way to do anything, but a couple of things that I think about is, really focus on your core competencies and what your core assets are. It's easy to kind of, when you're up into the right growth mode and significant growth mode, and you're raising money and capital is more available. It's easy to sort of start doing all sorts of different things. Get back to what you do best. What's the core competency of what your company is doing? What value do you bring to the company?
Right.
What makes you different? Stay focused on that and outcompete everybody. It's going to be a little bumpy ride for sure.
Yeah.
And
we're not sure how long it's going to last. So
yeah, we don't. And so I think that's where if I were an early stage CEO in this environment, what's on my mind is I'm raising capital, and I'm raising capital constantly. Even if I've got cash in the bank, I'm out, sowing the seeds of raising capital because we don't know how long it's going to last.
yeah, it's interesting you brought up focus on your core competence. And so the question, as I think about it with my portfolio companies, it's burn versus enterprise value creation. And so I can think of an example that we've talked about, which is if you're a SaaS company and you're selling, to businesses, do I keep my sales team if I've got to cut 20% so I can last for 18 months? Do I think about trimming engineering? So as a CFO, how have you helped companies make that specific decision on where to be?
Well, here's a really good, within the last 2 years is a really great example. The pandemic, we had to resize.
Right.
And so we looked at, well, what's the value creation? What are the areas that are going to continue to keep us sticky and keep us retaining our customers, but also what's going to potentially enable us to return to growth. And so what we did was we trimmed some areas in the company, but what we tried to do was protect the technology investments, customer success.
Yeah.
And, we were surgical about sales, but we really tried to keep the core of the sales team, really the go-to-market team, as I think that we had a good value proposition in that scenario. And so, if you have a good value proposition, you've just got to kind of hunker down and look at where are you going to put the most capital that will preserve your core assets? And in this case, it was technology and the ability to go to market and monetize them.
Yeah, it's interesting, and I've been in my own number of downturns. I'll keep that to myself. But what I remember three things. One is great companies will get funded through any environment. They will find a way to raise capital. It may not be at the valuation they would like. And so I want to come back to that. But secondly, we always come out, right? So we always come out of these times. And so at that point, you're evaluated on what you did when you were in. So in that example where you're a SaaS company and you're protecting your product roadmap or your differentiation, what would you recommend for a company that's like, doesn't have a ton of customers and traction? Like, what are some specific things that as a CEO you can use on that decision tree of where do I make those trade-offs?
I think it really goes back to you're really trying to, you may lose a few battles in order to win the war, so to speak. And so I think what you've got to do is really look at the market indicators to enable you to shift, because you may make a mistake initially, and you've got to really be nimble to shift quickly and say, okay, we think we should continue to invest in this one area, but not invest in this other area. And then you start, like, for example, say customer support and success. Yeah. Initially you thought, well, maybe we should cut that a little bit. And then all of a sudden you're getting customer feedback like, hey, we're not satisfied. And what's going to help you get out of a tough time when you've got limited capital and resources is that you've got to retain your customers. Right. That's your foundation. And then you can grow from there. But if you start losing your core customers, like for example, in a SaaS business, if your gross and net retention rates start, climbing because you've not continued to support or maintain the investment in support and success, it's going to be a bad deal. If you make a mistake, shift quickly. You got to move quickly. You don't have time. I think that's key. I mean, I look back at my own experience running companies, two things about what you said that I want to just reiterate. One is VCs don't like a value erosion. And so when you look at a company that had, 60 customers and then, that customer number is declining, or the revenue, the net, retention revenue is declining, that's very concerning. I imagine trading, being okay with the trade-off in growth rate, but not in value. And so I definitely think that's one. The other thing is a nuance of what you said, which is knowing what those metrics are and watching them on a regular basis. Right. So the microscope. So talk about how management teams should be looking at their metrics, but also how do they convey that to their board? Because as you said, I think the word you used was bumpy. So how do we look at our metrics on a regular basis? And then what kind of communication strategies are going to be important? Yeah, in tough environments like this, cash is king. And so you've got to have good cash visibility. And as a joke one time, in order to make a point, because in early stage startups, you're not fully funded, so you continue to need to raise capital as you go on. And so I always had a cash forecast. And then that's a joke. No. The joke is that it wasn't a cash forecast like for the quarter or for the year, or even for this week, in this month or this week. I actually said, oh, by the way, we burn this much per hour in cash. And they said, what? I said, yeah, this meeting is actually really expensive. And so, let's stay efficient on the meeting. What you're really looking for is capital efficiency. When you have limited capital, you've got to be as efficient as possible. And so cash and that cash visibility and what you're burning is everything, because they want you to be focused on that, both as a CEO, as a CFO, and a management team. How much runway do you have? When do you need to raise more capital? And immediately the board members and investors start thinking, okay, well, what do I need to do? How much dry powder have we set aside for this company? What's the next round look like? Is there another milestone, another valuation inflection point? And in tough times, it just takes longer.
It takes longer. Yeah, it's interesting. So for all those who don't know, Ken was my CFO when I was running kind of a growth stage company. And so when I joined the company, it didn't have a CFO. And so it was a Series B company. And one of the questions that just came up, Ken, is when to hire a CFO. I like to have someone around with finance experience throughout, the stages. But definitely, I want to hear your thoughts on when. But let me go back to what I learned in my experience with you. So in terms of communication strategy, first of all, when you have investors, they're going to call your CFO. And so, I think as a founder, you got to be okay and actually encourage that relationship, because it's not they don't trust you, but they're going to get look at my face and look at Ken's. Okay, when I was a CEO, they were getting this. And
yours is much better than mine.
They were doing that. And so there was this dynamic of, look, I'm focusing on the leading indicators, right? Like what's coming down the pipe, what's happening. And your CFO is really focused on the lagging, right? Especially. So how does a CEO of an early stage company think about building capacity? Because most don't know how to do cash forecasts. So where do we start to build that competency inside the business?
Well, so a couple of things. I'll get back to, maybe when you should hire a CFO.
Yeah.
But I think that, whether it's in-house folks, outsourced folks, even the CEO should know how much you're burning, because your board and your investors are going to ask you.
Right.
How much you burn, how much are you burning this month? How much runway do you have? And you've got to have that off the top of your head, and the tips of your fingers. So I think that it's simple projections. It's like, okay, this is how much about how much we're spending. This is how much we spend in people. It's how much we spend in other aspects of the business. How much is fixed?
Right. Interesting.
Versus variable, because the variable is what you have the ability to make an easier, quicker decision on. The fixed part, like for example, people, once you hire them, I always consider them relatively fixed.
Right.
And so I think that you just look at what is your quote unquote run rate that you spend in cash each month. And from there, it's pretty simple math for the most part. And any controller, any accounting manager, generally even any senior accountant can help a CEO do a cash forecast. It's one of those core competencies that we as finance folks just learn how to do early on in our careers.
I'm going to put you on the spot. I'm going to give you a quote. So tell me if this is true, because the nuance of fixed versus variable burn is one that I want no one to miss. So fixed burn being things that are difficult and expensive and costly to change, and the variable being the things that we can throttle based on what happens. Right. So is it true, yes or no, that when we're in these war times, are we more cautious about adding fixed burn and more able to add variable burn? So as CFO, are you encouraging your CEOs to more slowly add fixed and be a little bit more risk adjusted in adding variables? So how do you think about adding on both those sides of the ledger?
That's a great question. Yes, I am much more cautious around adding any burn, let alone fixed or variable, because I'm a CFO. And for those who know me, I'm also notoriously frugal. So I think that when the biggest parts of fixed for many early stage companies, it's people. Yeah, it's people, and it's maybe you have a building, although these days it's more of a hybrid for many companies, or even. But it's what can you turn off quickly? Right. Right. And so when you make a hiring decision, I'm very cautious about hiring decisions. In times like this, I would really look hard at maybe hiring consultants for the short term until you get more visibility, or you feel like you're on a path to generating more cash, or the ability to raise cash. So I think that's a big part of it. People is, like for example, most software companies, people is by far the largest single line item of cost. The other one that people sometimes don't think about is when you hire somebody, the fully loaded cost of
Yes.
hiring somebody, you've got benefits which are going up in the market between 8 and 12% year over year this year because healthcare continues to go up. So you've got all these sort of kind of hidden costs
Right.
that you may think of. But variable, I'm okay cautiously adding variable because I know I can turn it off if I have to. And but I think in these times, both CEOs, CFOs, and management teams really need to be scrutinizing any incremental cash spend that they're adding to the business. And it's really an investment. What's your ROI? What's the benefit you're going to get? What's the value? If I spend $1, I expect to get 3x that in value. And again, staying focused on the core competencies and the core assets, and trying to make sure that you're still promoting and building enterprise value.
Amen. And I would say as a principal, you came on after we raised, or you came on before we raised that series C. But the one thing that I remember doing, and with your involvement, was reporting burn as both fixed and variable to the board proactively. And so I would encourage any of my portcos to proactively communicate and to break out burn by both fixed as well as variable. I think that's a beautiful suggestion, Ken. So let's talk about who's in the finance team. So people mix these up all the time. So you've got a bookkeeper who's more transactional. You've got a controller who's thinking about controls and budgets. You've got a finance person, director of finance, VP, who can look holistically. And you've got a CFO who's actually a fiduciary, right? Who's actually working with the board on strategy. So when do I add these? And who's essential to my core team at the different stages of growth?
Yeah, it's a good question. For Series A, I think you need a bookkeeper and maybe like an accounting manager kind of resource. That's about it. You really don't. You just need somebody to pay bills and to make sure like the cash is well looked after. Plans are probably not quite as developed at that stage because you're still pretty early. Series B, you're now maybe finishing your product or and getting ready to sort of test it out in the market, and you're starting to get to a point where the technological risk is starting to become is lessened, and it's really at that point, I think between Series B and Series C, you really look for a CFO type. I think Series B, you probably have a controller,
right,
and then Series B to Series C, you really probably bring in a CFO, because now you're going to Series C, you're going to growth mode,
right,
and growth acceleration. And so it's market acceptance. And so really you've got to have someone in the finance role who's also very commercial from the perspective of dealing with customers and revenue and things like that. Good controller can take you pretty far. And that's where, sometimes Series B to Series C, maybe you don't need a full-time CFO. Maybe it's a fractional CFO. It depends on the business, depends on what your board makeup is like and what their preferences are. But it's either an early stage CFO or maybe a frac CFO in between. Series C, definitely you want an in-house CFO, because now you're in high growth mode and looking at potentially an IPO at some point if the markets were receptive. But either way, even if you're not going public, it's really growing the business. And I think that's where you really, I think entrepreneurs and founders and early stage CEOs really should probably look to get a CFO.
And I think it's, I've been reflecting, moving from CEO, moving to, venture capitalist. And one of the things that I thought a lot about after I worked with you was the importance of, I'm going to call it a bond. It's a professional bond between the CEO and, so, seed Series A, it's really about the CEO and maybe a co-founder. It's about that product. It's about customer acceptance. It's about that obsession on the experience. And then you move into, can we monetize this thing? And then it becomes about, you've got all these investors now, you've got other people's money, and you're carrying along that legacy with you. And so it becomes about protecting the investment of others, right? And also projecting the future. So the one challenge that I think most early stage CEOs run into is they get to that Series B, C stage, they've got to add a CFO, and maybe they add the wrong person. And you know, for me, I think we got lucky. I got lucky, I'll put it that way, in building a great relationship with you. But the CEO CFO relationship becomes tighter and more operational as the company scales and grows. I remember you were looking at our contracts holistically and protecting margin in the contracts. We were renegotiating leases. We were thinking about the compensation plans of our sales team. So it becomes less about looking at, you know, how much cash, and it becomes a lot more about operations and strategy. So how can a CEO find someone that they have a good relationship with before they hire and kind of test out those dynamics? Because it is a pretty involved relationship.
It's a great one. So a great question. I think that a lot of it comes down to when you're hiring your first CFO, what's that person's scalability? Oftentimes, oftentimes there's somebody who is maybe CFO in title, but they're really more a controller or VP of finance. And so they don't have maybe the fundraising background or the strategic operational background at scale. So that sometimes people grow into it and they do a great job.
Yeah.
Other times, maybe a little bit of a wall and they can't scale further. And I think that's where you've got to really think about as a CEO, is this person the right person, 4 or 5 years from now when we're, instead of, early revenue, we're $500 million, $1 billion kind of company. They're different skill sets. Early stage CFOs are different than later stage CFOs. And you'll meet some folks who can do both. But I think that you're looking for someone who will scale with you and help you grow the business. Secondly is really chemistry. It's fit, it's communication, and you and I, we always joke around this story when we first met. And sometimes opposites are the right match. When people sometimes when people get married, their spouse is very different than they are. And it's because you have complementary skills and complementary perspectives. And so I think that also can be a real strength. If the person is just like you, you're going to have the same strengths and maybe some of the same weaknesses.
Amen. And we could talk more about that, and we probably will later. So let me get your advice on that. I mean, right now, if you're a startup founder, you're thinking about extending that runway. And if you've got a finance person in your corner, they're giving you a lot of options. First, they want to cut things, which CFOs are very good at. And they also want to optimize. So how do we get more from what we've got? But they're also looking for alternative sources of capital. So as I tell every founder, raise venture capital when you're ready, because it's expensive capital. And I mean that both in the cost, but also in the not the burden, but the requirement of preserving this relationship and helping them get the return that we need as VCs. But can you talk about debt? And I mean, there's a pantheon. There's a lot of different type of debt. There's good debt, bad debt, whatever. But talk about debt and help us understand what are the obvious and the non-obvious costs of it.
Yeah, before I get to that answer, I think when you're a CFO, your responsibility is to be strategic in your thinking. And so, yes, I've been known to cut costs when necessary, but it's not always just, okay, we're going to cut. It's really like, well, we're going to cut here, but we're going to invest here. We're going to invest. So I think you got to really stay strategic, because again, the board and the CEO is looking for that. And the CFO is a reflection of the CEO. If you've got a really thoughtful, strategic CFO, the CEO is going to get a little bit of drafting credit for that, and saying like, yeah, this person is you guys are really thinking strategically. That's great. Back to sort of alternative types of funding. when you're an early stage company or a venture backed company, you know, some of the crazy stuff, like I hear jokes around like, oh, we should invest in, you know, we just raised, you know, 10 million bucks. Let's invest $1 million of it in crypto. I'm like, you're not going to get a lot of,
That's never happened.
Yeah, you're not going to get a lot of VCs who are going to be very receptive to that because it's just too volatile. But I think as you think about equity and debt or pseudo equity in the form of a convertible note.
Yeah.
Early stage, like Series A, Series B, usually it's equity more so than anything. Once you raise money, every debt service provider out there will be calling you saying, hey, do you need a working capital line, or do you need a term loan, or do you need equipment financing? And they're all places and circumstances where that may make sense. But generally speaking, the early stage companies, maybe a working capital line with a financing partner, whether it be your bank or some other venture debt player, that's not bad. You know, there's a reason for that, because it's an accordion line that you can typically draw down, and it's your choice. But it's expensive. It runs the gamut. The stronger you are financially, the better terms you'll get. The weaker your balance sheet looks, you know, venture debt guys may make that offer, but it'll be much more expensive. You know, typically high single digit to double digit interest rates, and sometimes some equity kicker in the form of warrants. It really depends. Oftentimes, you know, lines of credit with your commercial bank, whether it be an SVB or a bridge or other sort of technology-oriented banks, they usually do a pretty good job of pricing, doing a good job of pricing, because they'll ask you to manage all your cash, of course. But that's a good use, and you do it when you have money.
Right.
When you need money and your balance sheet is not as strong as you'd like, that's when the banks are going to be like, we're not comfortable with the credit risk. Their perspective is all that credit risk. Now let's talk about debt from an investor perspective.
Right.
Equity investors don't love a lot of debt, and the reason why is because it's typically a secured position that sits in priority in the face of a liquidation in front of equity, including management, CEOs, and any equity holders. So I think you've got to really look at it judiciously. Some people say, like, well, you know, debt dollars are cheaper than equity dollars. Sometimes it is.
Sometimes, yes.
But I think you've got to really be thoughtful as a CEO and as a CFO when you're making that proposal to add some debt to the balance sheet and flexibility, that, you know, you get buy-in from your investors. I just had a company that I was working with, and we had a credit sitting there, and a combination of line of credit and term loan. So we did the line of credit, but the term loan, it's like the investor said, like, no, it's because it wasn't enough money to make a difference for them. So I would be very thoughtful about it, but big fan of lines of credit, working capital lines. Not a huge fan early in the game around term loans. I think later, as a company matures, I mean, a term loan may make a lot of sense, but be very thoughtful.
Very thoughtful.
Because the investors don't love it.
Yeah, let me put that beautiful insight into context. So basically, as you're running your company, you're adding like safe notes, and you're adding equity investors, and you're doing your Series A, and you're pricing it, and you've got common stock now because your employees have it. So you've got what's called a stack or preference stack. And so to Ken's point, debt sits on top of equity. Yeah. And so if your company were to sell, that money comes off the top. So whatever you owe your debtors, that is first, and then the preferred stack, and then the common stack. And so when you're thinking about debt, kind of in your mind, imagine a stack of preferences and people. And so what you want to think, and Ken was just pointing to that, it comes before your team. So you could have, you know, a very little equity, but have a big debt stack that actually affects what you and your team are able to do in the event of an exit or some kind of transition. So that's one. You talked about venture debt. And so venture debt, I'm going to use SVB, I'm going to pick on them. They're giving you term loans, right, which is a fixed period of time, fixed amount of money that you get. And then line of credit is accessing based on requirement. I like that type of debt as a CEO, but as an investor, it adds a level of complexity. So talk about the nuance. Like, can you give an example of like this venture debt now has covenants? So those are expectations that a banker has of you. And so again, let's use the faces. I would be an investor, and then you've got a more stoic person who's a banker, and they are much more risk averse. So Ken, can you talk about what is the actual political cost? What are the unseeable, non-obvious costs associated with debt that may not be so apparent to people?
Yeah, there are a couple of things. So typically, debt comes with some covenants or parameters and constraints. And so if you don't stay within those boundaries or constraints, they call that tripping the covenants. And so what that does is it can make your debt callable and repayable upon demand, like maybe it's 30 days or what have you. So, and you may not have the money. So you really then have to be tracking as one of the KPIs.
Yes.
How are you doing against your debt covenants? And so typically there's monthly reporting. At Jumio, we had debt covenants that we had to track, and we were very thoughtful about them, because in the middle of the pandemic, the KPIs didn't look quite as good as they
Right.
did later on. So I think that's one thing, and that becomes a question, especially if the investors have a relationship with that lender. Like,
which is most likely.
They may say, like, come on, like, you need to show some flexibility. That may happen. But so that's one thing. Secondly, is that they're on your, if there are warrants involved with that debt, they're on your cap table. They're part of your investor group now. So that's typically they don't have the banks don't have a ton of influence because the position is small, and they don't take board seats and stuff like that. But it's just another thing to deal with.
Right.
So I do think that there's some situations where debt is really good, and it's a lower cost of capital. Oftentimes it's a lot higher than what you might think. So just be judicious about it.
Amen. Amen. So the takeaway is you got to build those relationships before you need them. Mm-hmm. And you want to secure as much access to capital before you need it, and then hit your numbers, right? So the three takeaways.
Always hit your numbers.
Always hit your numbers, which is hard in wartime.
It is hard all the time.
I mean, this era feels different than the past ones for me as an investor. And so I spent a lot more time with our portfolio companies than I would have expected, which is great. But how, and a lot of them are doing inside rounds, not necessarily our portfolio, but a lot of companies are doing inside rounds. So, or party rounds where your existing investors invest in your next round. So Ken, how do you know when to approach your investors? And how do you know when it might be better to do a party round or to go out and shop your deal? Like, how do CEOs and how do founders make the choice of when to start raising money and from whom?
Yeah, it's a really important question you just asked. First and foremost, going back to that cash forecast, how much cash do you have? What's your cash quote unquote runway or horizon? That's going to guide the timing of when you need to go and have a dialogue with your board around raising capital. And so from the time that you start raising capital, I would plan minimum 6 months. Sometimes you can do it faster. Oftentimes you can do it faster, but I think in maybe less uncertain times you can do it faster. I think these times it's just taking longer. And then you have a dialogue. You should go to the board when you have that dialogue with we think we need to raise X dollars, $20 million, $25 million, $10 million. And when you say that, please, please, please do have a logical thought process around how you got to that number. Here's what we're going to go use it. Here's what we feel we need to go and raise $20 million. Here's the use of proceeds or what we're going to spend it on. And that's how we're going to, and then tie it to the increase in growth and enterprise value. Then the board will say, okay, that seems to be a thoughtful, dialogue. How are you going to go do it? Oh, the markets are tough or what have you. And I think that one of the things that's a real silver lining here is that you always got to be optimistic. I think entrepreneurs and startup folks, they're naturally optimistic because they have to be. And so that optimism and that passion and that vision still has to come through. If you've got a great set of investors, you're very supportive of the company, they'll say, okay, well, why don't you go test the market and see what the market is saying? And your investors don't want a down round if possible, because that means that in their own portfolios, they're writing down their investments. But if you get some market data and you think your valuation is X, but the market's coming back and saying it's X minus something, the investors may in fact step up and say, look, we think it doesn't make sense to go outside. We'll cover 10 of the 20, and buy you some time. So because they don't want to write down their investments if they don't have to. An outside round, you're revaluing the company, and so that's from an investor's perspective. From an entrepreneur's perspective, you got to get the cash.
Totally.
So that's where you really need to work with your investors and your board members and making sure you've got full alignment. Here's what we're raising. Here's when we're raising it. Here's why we're raising it. And then it comes down to what's the economic deal or the price in terms or valuation in terms. And, they're on your side for the most part at that point, because a new investor is going to say, well, this company is not worth as much as the last round. They may say that. Or this company is worth twice what the last valuation was. But your investors and management, you're aligned with that. You want a better valuation on the next round. And so they're going to be pushing a new potential investor. You as an entrepreneur are going to be pushing the new investor. The new investor is going to say, well, yeah, but you want me to write the check, then here's what I can get comfortable with. So 6 months ahead of time, at least, go through and have a very logical thought process about how much you need to raise, what you're going to use it for, and when do you need it.
I love this because it's all about the details of what you just said. So a couple of things. So you'll be surprised by this, and I'm going to come back to the point you just made. When we're listening to pitches from our entrepreneurs, no one has ever said to me this question. Great promise. We look forward to having you as an investor. How much outside of this check will you put aside for us? So they never ask the dry powder question. So friends, if you're listening, ask the dry powder question. How much are your investors putting aside? So
Thomas, you may want to just say what are you referring to by dry powder?
So basically, I want entrepreneurs to understand the venture side of how the venture business works, and so they can understand the expectations. So every venture firm has its own strategy, which is when they invest, in whom, and how much they expect for that return to be based on what they invest. And so some firms are very much heavy on their first checks. They write a lot of small checks and they don't do follow-ons. Some write, few checks and they do heavy follow-on. So we're a low volume, high conviction shop. So that says it all, right? We're all about the handful of companies that we invest in, but not every investor is. And so I think it's important for entrepreneurs to ask the question, how many checks are you going to write out of this fund? This is of their VCs. And how much dry powder are you putting aside for me? Outside of this initial check, how much will you preserve of your fund for follow-on checks into my companies? That is the question that you must ask, because in these times, your investors may have no capital for you.
which means that they won't be able to support you when if times get really, really tough, because they don't have the money, as opposed to the companies that have set aside quote unquote dry powder, reserved capital for future rounds. They have the ability to support you if things get tougher than you expect.
So what advice do you have for CEOs in building better relationships with investors? Because what you're talking about is, and this is a nuance of what you said, is you're kind of assessing the market on your company's value before you have to actually fundraise. So do CEOs even think about this? And if not, how do they do this well?
Well, I think that they do. I mean, most private company CEOs who are not where their businesses are not fully funded, a big part of their job is fundraising.
Right.
I mean, as much as that's I've heard it a few times where that's a new learning. Like they didn't, I'm an engineer. I built this great technology or what have you. Wow, I spent a lot of time fundraising. but it is a bigger part of a startup CEO's job than most realize. And so you always got to be thinking about, being in tune with what's happening in the market or your segment and the investment environment. Right now the investment environment's tough, because it cascades from the public markets. And so when the public markets get tougher, then there aren't IPOs, there aren't as many transactions. Therefore, the private markets, it does trickle down into the private markets, because look, if I've got this great company and you're asking for a very large valuation, and the public company where I have total liquidity is not that much more, because sometimes in frothy times valuations of private companies get up there. They're looking at that kind of going, yeah, this private company is not worth that, I'm going to pass. And so you've always got to keep in tune what's going on in both the public market and how it cascades into the private market, because I think that's your funding environment and who you're going to.
Yeah, it's interesting. It reminds me of a quote of one of our LPs who said, it's a 10-year due diligence process. Investing in a company, you're just always doing due diligence and assessing. I mean, that's what it is. So should people be out fundraising right now? And what if they are offered worse terms, or they have to take a down round? Like, what, you need the money. How do you stay motivated? How do you keep your team excited if, it's not only an optics thing, but what they own is worth less. So what happens in that extreme situation where they've got to take money and it's worth, it makes their company worth less than it was before?
Yeah, so from an internal perspective and managing the teams, there's a couple of things. One, if your job is to get the company capitalized and have enough funds to operate the business. And so I'd argue if you have a reasonable bank account today, I'd still be out there with feelers, building those relationships, because you're building the relationships for the next round, and that takes time. And so oftentimes you continue to meet investors. If you're a Series A company, you're meeting investors who typically invest in Series B. And you build those relationships. And I learned a long time ago in a sales organization that business all about relationship. And so build those relationships. You're constantly out there. It doesn't mean that's 90% of your job, but it's you have to spend enough time doing it. So that's if you have capital and you're in good shape. If you don't have capital, you should be out fundraising now, and the market will tell you what when you talk to enough people, you'll get a pretty good sense and range of what a new funding round would come in at. There are some companies that aren't going to get funded. I'm a big believer. We started off earlier with the strong companies will get funded. Right. And the ones that are having a tougher time or don't have as strong of a value proposition may not get funded, and they ultimately ultimately strong survive and the weak do die eventually.
So do you have examples of that? Because we all think about Brian Chesky building Airbnb during a downturn, right? We all think about these examples. What examples do you give? And what are some of the strategies that those CEOs employed during those downturns?
Well, I think you got to stay committed. You got to have the conviction first and foremost. If you don't have that, you don't have that inherent optimism, because it's infectious. Even when it's tough, that will carry you most of the way, and your team picks up on it. If a CEO or a CFO is generally optimistic, the CEO will be the optimistic one, and the CFO should probably be cautiously optimistic. But I think that teams do take the cues from their leadership. If the leadership is sort of very emotional and sort of maybe having a tough time dealing with the situation, your team will pick up on it. So you've got to always be like I joke around and say that I don't get to really have a bad day, because if I have a bad day, somebody is saying, what's wrong? What's going on? Because CFO is not happy. So I think that you really have to ultimately stay positive. Secondly, if you do end up having to take a down round, people understand. The investment community understands. They get why this company did a down round. In the future, if you had a down round in your history, yeah, we had a down round. Don't hide from it. Just say we had a down round. It was tough. When companies were in the pandemic, were some of them got funded and maybe they took a down round. Yeah, it was the pandemic. We took a down round. We made it through. That was it. Becomes kind of just very matter of fact. So I'd be more forthright about it rather than try and not address it. And then I think as it relates to the team, hey, if you have a down round and maybe your options are a little bit lower than they were previously, you can always give them more options at the new price. Once you get funded, you can give them cash bonus for sticking it out. There's all sorts of different.
Did you actually say that? You said
I did.
B-word bonus.
I did.
Well,
it's sort of like a reward of hey, you sat in the foxhole. We made it to the other side. In fact, one of my companies just you're contemplating, it's a little symbolic thing, saying, hey, this was just a thank you that you stuck with us through the knothole, and we got through it, and we just appreciate you. I think those kinds of things that's a great investment, and you get tremendous return from your team.
And that's the benefit of discipline. And I love that you brought that up, because in these times, as CEOs, I imagine people want to make things look good, like, oh, everything's great, when it isn't, and people can kind of sense that. So my last question for you is, if I know that I have to do a significant cut, do I do it in pieces and hope things will get better? Or is it better to just sort of take the cut at once and just sort of deal with the consequences of it? Like, how do you think about making those tough calls?
Unfortunately, when you've been a CFO as long as I have, you've gone through this multiple times. Never fun.
Yeah.
Really, it stinks. It's no fun. I had a really tough one during the pandemic where really we had to lay off a lot of people, and these were people who were in a call center and a service center, and it was tough because these are people who are not well off.
Right.
But I would say that you typically do it fast.
Yeah.
You do it deeper than you think. Don't drip it. That's usually the kiss of death, because you don't want a second time.
Right.
Organizations can survive a one-time, reduction in force. If you keep doing it, you really lose that goodwill and the morale. Also, don't forget the people who are left, the people who are not affected, because they now are doing all the people's work that are no longer with the team anymore. So be swift, do it deeper than you think, so you don't have to do it again.
That's a great set of advice. So let's leave it on this. Let me ask you my last question, my actual last question. What are you excited about? Like coming out of this, what do you think is going to be good for founders?
I think that it's not just getting to the other side. I think for founders and early stage businesses, what made you decide to get involved, whether you're a founder and start the business or whether you decide to join an early stage company, there's a passion and a vision there. And so if you really thought about it at the beginning, it's not changed.
Right.
And so I think staying optimistic, I do think that business does run in cycles. We don't know what this cycle is going to look like. It could be some people think it's going to be a mild recession. I just read a report this morning, but a bunch of CEOs think that. The reality is they don't know. No one knows.
Yeah.
But you have to prepare for the worst, but be optimistic and try and execute for the best. And that's just being disciplined. That's paying attention to the details, and that's making conscious choices to sometimes lose small battles in order to win the war, and return to growth and build more enterprise value over the longer term. So I would just say stay committed and stay optimistic.
I love it. That's a great place to leave it. Stay committed, stay optimistic. Everyone, thank you for all the questions. Thank you, Ken, for all of your time. And thank you.